let's talk about State Bank of India. Well, the numbers were good, a 28% growth in the company's profit, as higher treasury income lifted the earnings. There was an improvement in asset quality, yet the stock on Friday slipped and was under pressure. So to talk more about SBI and the banking sector outlook, now that all the big earnings are out of the way, Dnyanada Vaidya, research analyst BFSI at Axis Securities, is now with us on the show. Thank you very much for joining in. Did you speak to your clients, about investors, about clients about State Bank of India? Are they willing to buy at current levels? What is the call now?
Hi, good morning. So yes, SBI did report a good set of numbers and we continue to remain positive on the stock. Asset quality, unlike some other big banking players, has not been a problem for SBI. We've not seen any stress in terms of slippages. So yes, we do continue to maintain a buy recommendation on the stock with a target price of 1,040.
Which is still a reasonable upside from here. Dnyanada, great to have you on the show. So I think this is something that has been a huge relief, right? The larger banks don't have the kind of asset quality and credit cost issues that are building up in smaller lenders or lenders with the microfinance exposure. So SBI is a buy for you. We are at the end of more or less at the end of the earnings season as well. What else stand out where you will get reasonable asset quality or credit costs within control? And maybe some growth as well, because on the other hand, there's this whole fight for deposits and, trying to protect margins. Who is winning that fight?
Right. So we continue to prefer the larger private sector banks. So we continue to remain positive on ICICI Bank. We don't see any major asset quality challenges in the bank. Also, HDFC, if we look at the bank, it's been able to maintain its asset quality across cycles. Currently, it's been dealing with the higher LDR, which is an issue, and hence growth will decelerate in FY25 before picking up slightly in FY26. But we believe that valuations for HDFC Bank are pretty attractive, and we remain positive on both HDFC and ICICI in the private sector. Amongst the mid-sized banks, we like Federal for its valuation comfort and also healthy delivery on the ROA front. So we expect a continuous ROA delivery of around 1.3%, at least for the next couple of years. Of course, the sector will face some headwinds on margins once the rate cut cycle begins, but that will be across players. In the PSU space, we like SBI.
SBI, yeah, that remains your key pick. So ICICI, HDFC Bank and SBI, all are three large cap banking picks. On SBI, let's just talk about this whole asset quality issue. As of now, there's absolutely no problem, right? I think it's all very well under control. The slippages number was also fine. Are you expecting any kind of hiccups at all in that target price of 1,040? What all are you penciling in terms of how much growth? What kind of NPA movements? Just tell us a little more.
So in terms of asset quality, there was a slight inch up in the SMA book because of a PSU account, but that's been pulled back. So we don't see any major asset quality challenges either from the retail or the corporate segment. So asset quality, in our view, should remain largely stable going ahead with controlled slippages. So credit costs eventually should also remain largely range bound between 50 to 60 basis points. In terms of growth, the bank has also alluded to strong growth demand coming in from retail assets, and also there is some pickup seen in certain segments. So that should aid credit growth for SBI. So we are penciling in around a 15% CAGR growth over FY24 to 27 in terms of credit. In terms of deposits, yes, there has been a lot of competition across players, but SBI remains well placed when it comes to a balanced LDR. So we expect that the deposit growth will continue to remain healthy. However, that growth will remain slightly lower below the credit growth, and we are penciling in around an 11% CAGR growth in terms of deposits. So margins should remain largely steady. So our estimates say that SBI should deliver an ROA of at least 1 to 1.1 over the next couple of years.
Okay. And finally, before we let you go, Dnyanada, just comment on the whole issue on MFI. That stress has showed up everywhere. We're looking at smaller lenders, MFI lenders, or today's Equitas, the stock's already down 3.5%, 4% in pre-open. We know what happened with credit access. On MFI, how much more pain system-wide would you look at? And also throw in a word on unsecured. If we should be expecting any accidents in the second half on that side.
Right. So MFI has been facing some problem even in the first quarter. So first half has been bad, and we expect the second half to see elevated slippages and elevated credit cost, with lenders having a higher share in the or having a higher exposure to the MFI segment. While commentary from lenders has been that October collections have more or less stabilized, we still see some kind of stress flowing in, resulting in elevated slippages. So yes, that will continue to hurt the asset quality and credit costs for lenders. In terms of unsecured, other than the MFI segment, there is some stress in the credit card portfolio, which will continue to show up in Q3. We'll wait and watch for trends in Q4, but overall, for the unsecured space, we believe that H2 will not have a very bright prospect.
Okay, so MFI and non-MFI unsecured, they remain key watch points from an asset quality perspective, even in the second half. Ananda got that. Thank you very much for joining in. Let's